split this final review into two sections. The first will be economic, and the last will focus on the budget. So you can go ahead and read this. I'll post that PowerPoint as well, but let's just go straight into what is economic policy. Anytime you see economic policy, it really focuses on these major things. It is called the nerve center of American politics because the economy sets the tone for the nation. If things are going good, more than likely in the economy, presidents will get elected. If things are going bad, they blame the president or Congress and they want to get them out. 3 goals. You want high employment, low inflation, which means the value of the dollar will hold, and economic growth. When you go to college, you will probably study these 2 areas. Macroeconomics is the big picture, and microeconomics is studying tinier things. We're going to focus on macroeconomics first. The overall level of economic activity is regulated by the flow of income, money coming in, and money going out, income and expenditures. 2 ways we can look at this is through fiscal, which is the budget, and monetary, which is the flow of money in and out of the economy. We're going to focus on fiscal policy first. This is a very basic definition, and I'm going to go into the politics of budget making in the next one, but this is really basic. Federal budget is spending and revenue. We do not have a balanced budget amendment. The state of Missouri does, but the federal government can overspend. When total revenue is greater than what we spend, we of course have a budget surplus. But when spending is greater than revenue, and this is where we are right now, we are $17 trillion in debt, the result is the deficit. When we borrow money to pay accumulated deficits, that equals the national debt. So a deficit is a year term used to say if we have gone over or not, and all the deficits added together equal our national debt, and our national debt is currently $17 trillion. Let's focus on the basics of monetary policy. Anytime you see this word monetary, just think money. The flow of money in and out of the economy, and that is regulated by the Federal Reserve. So let me give you a couple basics. To regulate the amount of credit in the economy, we do this through 2 ways. We raise and lower interest rates. For example, if you want to buy a house, a very high interest rate would be anything over 6%. Sometimes when the economy is bad, it might be 8, 10, 12% to get an interest rate. Currently, the interest rate is about 4 to 5% for a house. So when the interest rate is high, they try to cool down the economy, which means it's harder to borrow money. If the interest rate is low, they're trying to stimulate the economy to encourage people to take out long-term loans and spend money. Another thing that they can do is expand or contract the money supply. And the group that does this is called monetarism. The supply of money is the key to a nation's health. Keynesianism, and John Maynard Keynes was one of the first ones, but monetary policy is you have to take into account how much money is in the economy or out. If you have too much money in, it causes inflation. If you have too little money, it causes a stagnant growth. So what is the result of high interest rates? What is the result of low money supply? When you have low money supply, it's harder to borrow money. When you have high interest rates, it's harder to borrow money because nobody wants to do that. So both are ways of the government to control if the economy is overheated or if they need to stimulate the economy. And that would be the term stimulus, if the government tries to pump money into the economy through jobs programs, etc. Again, monetary policy focuses on the amount of money in and out of the economy. The key here on monetary policy is who regulates it. And if you have taken any of the AP exams, you have probably seen this practice question several times. The Federal Reserve, right here, is the key to regulating monetary policy. It was created in 1913 by Congress. It regulates the lending practices of banks. Some people call the Federal Reserve the bank of the banking system, the banker's bank. It is run by a board of governors. There are 7 total. Currently, the chair is Janet Yellen, and some people consider, sorry, my pen's not working well. Some people consider that position one of the most powerful in the world, really, because it controls the United States dollar system. The chairman is appointed by the president. It does need Senate confirmation. The Federal Reserve is very important because it helps regulate the flow of money. Anytime you see the policy-making body of the Fed, so if we're going to make policy about borrowing and lending money, oftentimes the Federal Open Market Committee, the FOMC, is the one responsible for putting forth policy-making portions. Tools of the Federal Reserve. What can the Federal Reserve do? They can establish what proportion of a bank's deposit can be used to make loans. So let's say that only 30% of your money can be loaned out. So they make sure that there are reserves in every bank. They can give you a discount rate. The rate banks can borrow from the regional Fed if they need additional reserves. For example, if you look on a dollar bill, it will say a Federal Reserve with a letter. It used to have a letter. Kansas City has a Federal Reserve, Dallas, Denver. There's tons of regional Federal Reserve areas, and that's where our bankers go to secure money. You can also do open market transaction. The Fed, and when I say the Fed, I mean the Federal Reserve. The Fed buys and sells U.S. government securities. If the federal government buys, then it means deposits extra reserves and banks can expand loans. And if the Fed sells, banks need reserve accounts, and it reduces the supply of money in the economy. The Federal Reserve, again, is called the Fed, and I want to go over several economic policy groups, and I think you've seen these, but I want to go specifically over the role of who has a hand in this area. First of all, the Federal Reserve controls the amount of money in and out of the economy. Next is called the CEA, the Council of Economic Advisors, experts who are responsible for forecasting economic trends. They are the ones who report to the president, and they help the president with his economic policy. So this is his trusted group of advisors, the CEA. Now, the Secretary of the Treasury, this is a cabinet-level position, so it is a bureaucratic area. Remember, the Treasury is in charge of coining and printing money. So he's in charge of making the money. It's the Secretary of the Treasurers. If you pull out your dollar bill, their signature is on the money. And they analyze financial community opinion, estimate revenue in and out of the country, and is the spokesman for the United States to financial institutions such as the Federal Reserve. So the Secretary of Treasury is a major player in the economy, but they have to work hand in hand with the Federal Reserve, who supplies the money in and out of the economy. You have seen the OMB before. The Office of Management and Budget is working for the president, and they are the ones who help with personnel, but also they prepare the budget for the president, which is sent to Congress, and I'll go over that in more detail in a little bit. The last portion I want to go over, if you ever take a course in college called microeconomics, you look at the tinier things that government sectors can do to help out the economy. Things such as tax incentives, especially for businesses coming in and out. Missouri and Kansas offer different tax incentives to businesses, and that's ways that states can help promote and regions can help promote business activity. The government can give a subsidy or a loan, give grants and loans to individual businesses and state governments. It's called a tax subsidy. For example, a grant to repair bridges or sewers, a loan to college students. You guys might have heard of the Perkins that you might be able to qualify for college. They also offer regulations, and when we regulate the economy, such as mandates on cars for fuel efficiency, gas emissions. These are rules that government agencies write that can be enforced by penalizing those who violate them. So those are examples of microeconomics. I'm going to stop there and start the next PowerPoint, which is going to be on entitlements and social policy.